Welcome back to our intermediate financial accounting class. In our last segment, we started talking about inventory, why it's important, how we need to track it both as internal and external stakeholders, and then we started talking about the big question for inventory, which is when can we actually record it as being ours? And even though we didn't mention it at the time, I'm going to mention it now, knowing that we can only record inventory when we have ownership or title transfers to us is one of our key concepts. Now that we've talked about all those details, it's time to put it all together with an example, and here it is. UNO Incorporated recorded $400,000 of inventory on 12/31 year 1. So now as we move into year 2, that's going to be our beginning inventory, right? Because whatever you walked out of the store owning on 12/31 is what you're going to walk into on 1/1 as the new year begins. So ending inventory on all the ending balances from the previous period are going to become our beginning balances in the next period. Over the course of the year, UNO purchased $2.4 million of additional inventory. Half of it was sold on terms of 210 net 30, and we always make sure we take a discount when there's one available. In addition, we sent back $250,000 worth of inventory because it just wasn't the way we wanted it. And that $250,000, that would have qualified for a discount. It was in that half of the $2.4 million that would have gotten a discount if we had kept it. On 12/31 of year 2, we did a count. We've got $250,000 of inventory on hand in the warehouse. $50,000 of that is on consignment. Another $200,000 of inventory is being shipped FOB destination. We want to know cost of goods sold. Now this formula for calculating cost of goods sold is so important in accounting. We see it in financial statements. We use it to check and double check numbers that are reported even in a perpetual inventory system. It's essential for a periodic inventory system. So this equation, beginning inventory plus net purchases equals cost of goods available for sale. Cost of goods available for sale minus ending inventory gives us cost of goods sold. That equation and how to use it, that's one of our key concepts in dealing with inventory. So be sure you're comfortable with it. With that kind of background on how important this is, let's take a look at how we calculate cost of goods sold. When we did it before back in our discussion of the accounting cycle, we did it both as T accounts and journal entries and as an equation. We're going to focus on the equation now so that we can see again what it looks like in an income statement. So we would start with a cost of goods sold heading, and we'll start with beginning inventory, and that was given to us. $400,000 is beginning inventory, so I'm going to put that in. 400,000. Next, I'm going to add my net purchases, and the first part of net purchases, of course, is gross purchases, and they were $2.4 million. Next, I need my returns and my allowances. We're going to start with returns because they're given to us. We returned $250,000 worth of this $2.4 million. So we don't have it anymore. Next is our discounts, and we were told how the discounts are calculated, but not what they are. So we need to calculate our discounts over here. So let's see, we were told that half of our purchases qualified for discounts. So 1.2 million was sold to us with a discount, 210 net 30. We can pay in 10 days, get a 2% discount. But of that 1.2 million, we were told that the 250 returned was part of that group. So we didn't keep the full 1.2 million. We only kept 950,000 that would qualify for this discount. Now that I know the amount that I actually bought and kept that qualified for the discount, I can calculate my discount. So 950,000 times 2%, I saved 19,000, and that's the number that'll go in here. And if I add all those up, I get my net purchases. So let's see, 2.4 minus 250,000 minus 19,000 is 2,131,000. Now to that number I would add, if I had any freight charges. In this case UNO doesn't deal with freight charges, so we don't have to worry about that. So we can take beginning inventory plus net purchases, 0 for freight in, and get cost of goods available for sale. So 2.131 million plus 400,000 is $2,531,000. Final part of my equation, remember, is cost of goods available for sale minus ending inventory, so less ending inventory. Now we need to calculate this value as well. Let's take a look at what it was. It says we have 250,000 in our warehouse when we counted everything up, but 50,000 of that is on consignment, and we have 200,000 being shipped FOB destination. So first off, if it's on consignment in my warehouse, then it's not mine. It's somebody else's that I am selling for them. Inventory doesn't belong to me, but I'm going to get a commission as I sell it. So of the 250, I'm going to take out the 50,000 that's not mine or UNO's. So I've got 200,000 there. The next question is this FOB destination. And the key word here is it's FOB destination. I have purchased it, but it's FOB destination, which means it isn't going to be mine or UNO's until it gets to UNO's warehouse and the shipment has been completed. So I don't actually have to worry about that one. And my ending inventory is just $200,000. And that's what I'm going to put into my equation. If I take the 2,531,000 minus 200,000, I get my cost of goods sold, so 2,331,000. And that's this company's cost of goods sold. Remember, we have to keep track. Can I count this inventory as mine or not? One of the other main challenges that we deal with inventory is the fact that there are all sorts of errors with inventory. Remember, there's a lot of quantities involved. They're very fluid. There's a large incentive for them to be stolen. One of my favorite stories about inventory actually came from a friend of mine who had worked as the head of security for a department store. So think JCPenney's, Kohl's kind of a thing. And his job, or one of his jobs, was to reduce the theft of inventory. And he had all sorts of stories about people. He talked about a woman pushing around a baby stroller. It was one of those really big ones where you put the baby's car seat in the stroller, and then you have a basket down at the bottom. And when they stopped her, she had stuffed all sorts of stuff into the bottom of this stroller that really didn't belong to her. Other stories include losing a bunch of inventory between the shipping dock where they received it and they logged it as coming in, and it getting out onto the floor, and they couldn't figure it out. And finally put in some video cameras and check some things out, and turns out that their employees were actually going in, sorting these clothes. They'd find something they liked, they'd take off their shirt, put this other t-shirt or other shirt on, and then put their normal shirt back on, and they would walk out with 2 or 3 different shirts on, and nobody was noticing that they were stealing this, right? There was so much focus on front-end theft that they were forgetting employee theft. So this is a big issue, being able to track inventory and realize that it's so liquid. In addition to people just plain ripping us off, though, it's just easy to make a mistake. Doing inventory, where you go out and you count every single piece, it's easy to slip up a little bit. And because of that, we see mistakes in our inventory count all the time, not just from theft, but from just plain legitimate mistakes. And it will change our financial numbers when we have these mistakes. There's 3 possible errors when we're accounting for inventory changes. There's some other things that can happen that aren't as common, but these are the big ones. First, we can report the purchases incorrectly, and that means that either we show too much or too little in our cost of goods available for sale, and that's going to flow to cost of goods sold, which will then flow into net income. We can get the purchases correct, but get the ending inventory wrong. Well, now everything's fine up through cost of goods available for sale, but I mess up my ending, and now that messes up net income because ending inventory was wrong. Then we can mess up everything. We can get both purchases and ending inventory wrong. So we need to be comfortable with figuring out what a mistake does to our financial records. And again, another one of these key concepts is understanding if I make this mistake in purchases or this mistake in ending inventory, what will it do to net income? So let's take a look at a couple of examples so we can be comfortable with this concept. So first question here, will net income be over or understated if $4,000 of goods held on consignment were included in ending inventory. Well, the easiest way to do this is actually to set it up in kind of a formal way. So the problem here is we're going to report ending inventory is too high, because if we're holding them on consignment in our store, then they're not ours. So if ending inventory is too high, then cost of goods sold, which is cost of goods available for sale minus ending inventory. If this number is too high, cost of goods sold will be too low. If cost of goods sold is too low, then net income is too high. Now the flip side of an inventory error is what happens next year. If ending inventory is too high now, then beginning inventory will be too high next year. So next year, beginning inventory will be too high, which means that cost of goods sold will end up being too high because cost of goods available for sale will be too big. Ending inventory hopefully will be right the second time. So cost of goods sold will be too high. So in the second year, net income will be too low. What's interesting about these errors is that if I don't make any other mistakes, these two are going to cancel out. And the effect on retained earnings, we think about this, net income is too high and then too low, those amounts will be the same and they'll cancel out. And the net effect on retained earnings over 2 years will be nothing. It's what we call counterbalancing. It's a formal accounting term that means when you make a mistake, it will fix itself as long as you make no future mistakes. Let's take a look at another one. Ending inventory was understated by $5,000 last year. So in this case, beginning inventory is too low because ending inventory was too low last time. So cost of goods available for sale will be too low again, which means my cost of goods sold will be too low, which means net income will be too high. Now again, it's too high this year. Last year, though, it would have been too low, and the effect on retained earnings would be zero because these two are counterbalancing and they would offset each other. Last one we want to look at, we could do a million of these, but let's just look at one more. Will net income for this period be over or understated if $15,000 of FOB shipping point purchases still in transit were included in purchases? Go ahead and do this one on your own. The net income effect would be zero. This is actually right. FOB shipping point purchases became ours as soon as they shipped, and so I included them in purchases just like I should have, so net income is right. So I don't have to worry about it. The moral of this last example is the fact that there's just a lot going on in inventory. And sometimes we may think there's a mistake when there's really not a mistake, or there is a mistake and we think there's not. We just have to be careful because there's so much going on here. And it's really important to a business. Those numbers, gross profit, sales minus cost of goods sold, and net income, which flows through from gross profit and cost of goods sold, if we get them wrong, a lot of people are going to be upset about it. So we have to be careful dealing with inventory. We've talked about a lot in this segment. We've talked about the cost of goods sold equation and how to handle errors in inventory, what the effects will be, and also that if we leave them be, they'll counterbalance. Both key concepts that we want to be comfortable with as we move on into the next segment. And I will see you then.